Guys, welcome back to another episode of How to Invest in Commercial Real Estate. And we've got a good topic today. We thought we'd focus on market conditions because we've kind of got a storm brewing in commercial real estate. And, we don't want anybody to be scared about that, but the storm might bring some opportunities. And we want to make sure we discuss why is there going to be a storm? How bad is the storm going to be? And why will the storm produce investable opportunities that you guys want to take advantage of? So that's the topic today.
It's kind of a paradigm when you think about it. It's a storm, and it could be causing all of these potential foreclosures, but at the same time, it's massive opportunity. So, interesting one to walk through.
Yeah, storms also always give an opportunity for good deals.
And if it's hard for you guys to conceptualize why that is with commercial real estate, just compare it to something that you're more familiar with, which is investing in the stock market. If you haven't lived under a rock and you're not still in high school and you're an adult and you have any money invested in the market, you're going to know that the market goes up and the market comes down. And you're also going to know that the best time to buy is not at the top of the market, but it's at the bottom of the market. The problem is when the market's crashing, nobody wants to buy. They're all afraid. And so you think back to 2008, the market's crashing and crashing and crashing, and everybody's, it's crashing because people are selling, right? They're selling their stocks, causing the pricing to go back down. But generational opportunities were available to all those that purchased stock after the 2008 crash.
So let's capture that, right? Somebody buying stock in the 2008 crash had the ideal that there's an opportunity here. It's a discounted stock today. There's risk associated with it, but I believe in this good stock, and that in a good economy, it'll be a good investment. And I think we have to put those same glasses on when we're looking at real estate opportunities, right? Because it's not like you're just going to walk into this amazing opportunity. It's going to cash flow amazing in this shitty economy. No, it just got foreclosed on. Like you're buying.
It may have no cash flow.
It may have no cash flow. It may just be in a great location, or somebody maybe just over leveraged it, and there's not much wrong with it. But the thing is, you're still having to wait for this good economy, right? But you made your money on the buy, I guess is what I'm trying to say.
Yeah. And I think the market bottomed out in maybe March of 2009, if I have to remember.
That's about right.
And it bottomed, the Dow bottomed out at like 6,000. Okay, what is it today? 35,000?
Yeah, something like
right?
that.
Six times, 600%. Now it's been a few years, it's been 15 years. But if you could, raise your invested capital 6 times, 600% in 15 years, you would do it.
Yeah.
So let's move back to real estate then. Why is there a storm coming in real estate? And we're going to try to answer that for you. First is we should put up, I'm going to give you the graph of interest rates. I want to do that.
Are we doing like Wall Street Prime or?
Yeah, just like the U.S. Treasury, 10-year Treasury note, right? We're going to graph that for you. What it's done in my entire life is gone from up here all the way down to almost zero down here. And so through that process, real estate pricing has gone up, lending's been more aggressive. And so after the crash, real estate was kind of depressed, but since the crash of 2008, real estate's done nothing but take off like a rocket ship. All the while, interest rates driving down. And so those things correlate with each other. The more real estate goes up, the more equity people can pull out, and the more they can go buy more. And then as interest rates go down, the more they can pay for new assets. And so it kind of feeds on itself.
Yeah, you got to imagine like a guy on a street corner saying, I give away money for 3%. Like you can do a lot of stuff with 3% debt that you can't do with 8% debt. I mean, that's a massive amount of money. I did some rough math. A 2% interest rate change on a $5.5 million loan is $110,000 a year. It's $110,000 a year. Yeah, that's probably the entire return they were expecting on a $5.5 million loan in the first place.
Yeah, it could be.
Okay, so Joel, it's done nothing but go up. Why do we think that the prices are going to go down? Why do we think there's going to be some decrease in prices and some good deals out there?
Well, first of all, why did the prices go up so much? One, inflation. Okay, it moves along, and it was pretty low for years after the crash of 2008. But what we had is a perfect storm of extremely low interest rates. We had COVID, where trillions of dollars were pumped into the economy, right? causing massive inflation. Inflation is typically at 1 or 2%. It was all the way up at like 9%, 10%. And so, and with all this money in the economy, it just flooded money into commercial real estate assets.
Well, it's amazing when you shut down the economy, you have to mail everybody money, so it re-stimulates the economy.
Yeah.
And when you think about it, that's what we did. And right now, we're taking money out of the economy and we're raising the cost of interest rates to try to slow down, right?
Yeah. So the main reason prices are going to come down is that interest rates have doubled. So we were borrowing at, I got a HUD rate. I didn't close it, but I got a HUD rate. It was like 2.6, 2.8%. You have Fannie Freddie debt around the same, 3%. We had commercial retail loans from just banks at 3.5, 3.75, 4. Mm-hmm. Well, today you're looking at 7.5. You might get a 6.5 or 7 from like a Fannie Freddie, which is still double the 3% that it was. And so what that does, commercial real estate, it's a leverage game. And most commercial real estate's built on borrowing 60, 70, 80% of the total with that debt. And so if the debt gets more expensive, it limits the amount you can pay for that asset and still make money. So these rise in interest rates, especially as fast as they're happening, is going to cause prices to come down some because people just can't pay what they normally pay. Now you say, well, why don't they hold it? Some will hold it. Okay. But eventually people have to sell for whatever reason. They may have a loan coming due. They may have a death in the family. They may need the money for a business venture. Just some reason people need to sell. And so forcing people to sell when interest rates are really high causes the prices to tick down.
Well, could there also be a situation where someone has to refinance and refinancing at the new interest rates? They can't even, their NOI doesn't even cover the increase in debt service, and they're either going to, like we said before, either give it back to the bank or they're going to need a fire sale, right?
Yeah, so we can't forget about how these loans work. Like Joel said, it is a leverage game. That's how real estate is played, because you're leveraging the bank's low rates to make a higher return on less amount of money. That's the name of the game, right? So when a loan is expiring and you have to go refinance that, they're going to quote or an appraisal or selling the property. It's all going to be the same thing. A bank's going to say, yeah, I'll give you 75% loan to cost or loan to value or a 1.25 debt service coverage ratio, whichever's less, right? Mm-hmm. So, but it has to cover, right? They have debt service coverage ratio requirements, and they want you to cover the cost of the debt service by at least 1.2. So that's your leverage rate. And in today's rates at 7% or double whatever it is, that means your leverage rate could be 50%. Right. But you went in and borrowed 75%. So now the bank is saying, no, we'll refinance this, but you owe us $2 million. Where are you going to get that $2 million? You can't get it from loan proceeds. If you were to sell the property, you probably couldn't get enough funds to pay off the loan. So that's when this is going into foreclosure.
Yeah. If you purchased real estate 15 years ago, then you maybe haven't refinanced for whatever reason, maybe you got a long-term loan. Yeah, you're okay because the property's appreciated in value. The income has gone up. Mm-hmm. And so if you did go put debt on it, even if the debt's higher, it'll still cover the debt service. Yeah. Where the problem's going to be is that we've had, from about 2016, 17 until now, but especially 2020, 2021, is that the prices were going up so fast and the debt was so cheap that people just were buying at the very top of the market. Yeah. And they may have not fixed their interest rate. Maybe they got a bridge loan. Maybe they got a 5-year fix. Well, if you bought in 2018 and you got a 5-year fix, and let's say your rate was 3, well, now your loan's coming due. Mm-hmm. And you haven't had enough time for that property value to go up enough or for the income to go up enough to handle double the debt service.
And you haven't paid down a whole lot of principal.
Yeah, 5 years, you haven't paid down much of anything. Yeah. And so those are the people that are going to really struggle when they go to refinance. That's where the opportunities are going to come.
Yeah, and it adds a lot of risk on the business plan, right? Because the best asset in an amazing business plan, like if you needed 5 to 7% rent growth and you had an amazing asset, you probably got that. But for a property that was maybe on the borderline of working, it's now definitely not working, right? Because the cost of this debt is just so expensive.
Let me give you a real life example, maybe a couple of them, but one, About 3 years ago, 3 or 4 years ago, I got hit up by some guys out of Texas. I won't give the exact city or the exact property name, but they called me and they were like, "Hey, we're looking for equity. Your name's Precision Equity. Do you guys want to invest with us on this apartment deal?" I'm like, "Well, I happen to specialize in, workforce housing apartments in Tulsa. Which one is it?" And they told me, and it's really close to stuff I own. And so I know what I paid for mine. And this is across the street, and they said, "Well, we're going to pay this X price." I think it was like $65 a door, and I was like, "Guys, that's a heavy price for that." And they're like, "Oh yeah, well we've just been hitting home runs on buying apartments, and we're going to buy this. We're going to put bridge debt on it, which means bridge debt means that it's most likely floating and it's short term." Okay,
because they couldn't get a better long-term option. Again.
Well, I think reason they put bridge debt on is because they were in this mindset that everything's going to keep just going up, and we're going to fix it up, and then we're going to flip it for $1 million, $2 million, $3 million in profit. So they didn't want a long-term loan because they were going to fix it up and going to sell it for profit. Gotcha. And they didn't want that prepay penalty.
Okay.
So I said, "Guys, look, I don't feel comfortable at this price level paying for this asset in this location in Tulsa." And I asked them, like, when did you guys start investing in multifamily? And they're like, "Oh, 2016, And I'm thinking, well, that answers a lot because they've never had a loser, right? 2016 till the time I was talking to them, the market was just shooting up and interest rates were plummeting. And so they thought, man, every deal we touch is gold. We are so good at this.
It's like the Wolf of Wall Street line. Can we just cut that in? I tell all my clients, don't judge me by my winners.
I ask them to judge me on my losers because I have so few.
So, fast forward 3 years, and it's in receivership.
Oh, really?
Right? It's getting foreclosed on, and I think they paid $65 a door, and the whisper price is that I might be able to buy this thing for $40, $45 a door. So not only are they losing 100% of their equity, the bank might be losing millions of dollars as well. And that's just one example of how this thing is going to play out. So let's ask this question real quick, and then we're gonna dive into how to take advantage of the opportunities. Why is Criterion and why is Precision? Why are we not at risk? Why can't we get hurt from this storm?
Yeah, I mean, just a year or two ago when you said, debt was so cheap, I think very specifically, we were paying more than the cheapest option to fix it for as long as we could. So everyone always quotes a 5-year rate. They just kind of do. But we said, hey, would you guys fix it for longer? Would you guys do 7 years? Would you guys do 10 years? And yeah, they may be 20, 25 basis points more expensive, maybe more, depending on where you're at or how the economy is. But a lot of the times that's worth it, right? Because if you have any disparity on, or any disparity in rate, like say you could borrow at 3% for 5 years, but if you want to lock it in for 10 years, it's 3.5 or 3.75. Well, like debt doesn't need to go up that much for that to be a home run of a deal for you. Like it's less than a point of disparity, and interest rates move within a point all the time. I mean, they're constantly fluctuating. Yeah. So fixing for as long as possible and be willing to pay for that fix and an increased rate premium, I think is valuable. And we did that, right? Yeah. So we have lots of deals that are locked for 10 years.
And neither Precision or Criterion, neither one have any variable rate loans, right?
Well,
at least on existing assets, maybe on some development.
Yeah, on development we have a few, sure, but that's not on a completed asset now. Yeah.
I would say the same thing. We really focused on fixing the debt for as long as possible.
Yep.
That doesn't mean, guys, that we have zero exposure. Okay.
Sure.
I have some loans that are coming due in the next couple of years. And so we'll see what interest rates are doing 2 years from now. But yeah, we fixed as many of them as we could for 10. And if we didn't fix them for 10, we fixed them for 5. And a lot of the loans that we have, we refinanced kind of in the post-COVID world where the interest rates were really low. We were refinancing and fixing for 5 years at least on those. So we have maybe some exposure, but not very much.
So worst case, when maybe some of these loans come up due in 3 years or 2 years or whatever, I suppose we could refinance, maybe distributions might have to get cut back for a while until interest rates drop further, and then we can refinance at a lower rate and then start to catch back up on distributions. Is that?
Yeah, for sure. It's whatever you have to do in that scenario.
Yeah, and keep in mind, we can always change the leverage fulcrum. We can always change that. We don't have to be so high on the leverage, and that
Right.
gives you less yield, but it gives you more security. So I think you're constantly evaluating that. And then even more than that is timing, right? Like we've seen the writing on the wall for years on this.
We even actually missed out on deals because we thought this was coming several years ago.
Sure.
And so we passed on some stuff that like the example I was telling you guys about, where I was like, no, this doesn't feel right. And we passed, and sure enough, there they are in foreclosure.
So what I'm getting at though is nobody got surprised with, oh shit, debt's expensive. I woke up one day and debt's 8%, right? So if you have loans, you should know when those loans expire. And if you see, the debt market going to hell in a handbag and getting expensive really quick, it may be worth conversation to your lender a couple years beforehand. Hey, I see debt starting to tick up a little bit. I've got a loan expiring in a couple years. What would a refi look like today? Mm-hmm. Can I go ahead and lock that in? Yeah, you can. That's a great idea. There's things you can do proactively to prevent yourself getting foreclosed on, thinking you know everything. That, and again, the banks give you a leverage point and a debt service coverage ratio requirement, but you can still go get like mezzanine debt or a second loan or some sort of unsecured loan. The more you borrow, the more you're at risk because they're guaranteed terms. A lot of investor equity isn't guaranteed recourse. So they don't have guaranteed minimum rates that you have to pay out. I mean, debt is just inherently a lot riskier in the form of recourse than equity is.
Okay, so now that we've talked about why there's a crash coming and why we may or may not be exposed to it, let's talk about the opportunity, because that's really what we want to focus on. Is the next few years are going to provide a lot of investing opportunity. And to go back to the example of getting foreclosed on, some owners are going to get double whammied when it's time to refinance, their debt's due, the debt is double, and they had a huge tenant or two move out like right before they have to refinance, which significantly dropped their NOI. And so there's going to be people that just didn't plan on that, and they go to refinance and they can't. They can't refinance because they borrowed 80% and now they can only get 45% debt on it. And they can't sell it because they have to pay off that note at 80%. And so it's just going to put a lot of people in a very difficult position. And once again, it's not everybody, but we don't need everybody to be foreclosed on. That would be catastrophic. All we need is 1 out of 100 or 1 out of 1,000, because that still is a lot of properties to pick up on the cheap. And so we're excited about this because we feel like anybody that was new to the investing business, in the late 20-teens, early 2020s, and they just felt like they couldn't miss, they couldn't lose, and they got cheap debt and they didn't fix it for long enough, and they overpaid for the asset. And so those are the ones that we think are really going to have a hard time. And we're not excited about them going through foreclosure, but we're excited about being able to pick up assets at really low price points. Now, like you were saying at the beginning of the show, it doesn't mean that it's going to look sexy or that it's going to look like a good deal or it's going to cash flow, okay? The thing about good deals, I'll say it again, good deals don't look like good deals. Otherwise, everybody would be buying them, right? So they're going to look a little messy. They're going to look a little risky. And so, but if you have really good fundamental market knowledge, you're going to know, okay, this apartment complex, the one I was talking about earlier, it sold for $65,000 a door. I can buy it for $40 a door. It probably doesn't look like it's worth $40 a door today. Maybe it looks like it's worth $30 a door, but eventually it's going to be worth $65 again a door. And so there's millions of dollars of profit there. So can I get that asset, get control of that asset, and break it even, make it work, and wait for these rates to come down and wait for inflation to do its magic, and then sell later? That's what we're looking for.
It's hard to make sense of now without forgetting some of the competition in a good economy, right? In a good economy, these assets are going out sometimes unpriced, sometimes with a dozen or more bidders.
Yep.
And it's hard to stand out above the crowd, and it's hard to buy great deals. We can't forget about those times, because that's a lot of the advantage right now, is getting the opportunity to buy that asset. A lot of people can't make it work. They won't make it work, whatever it is. But like you said, if it looked like a great deal in a great economy, there'd be a dozen people bidding on it, and it would be hard. You would end up driving the price higher and higher and higher and making less and less money. So that's a lot of the advantage right now, is you kind of get to take your pick. Oh, that's a great asset. Nobody wants to buy that right now.
Yeah.
Nobody wants to buy that right now. If I can just buy it, I know it'll be good. And if it's that much of a stretch, right now, like it's got to be a great deal. Again, later on in a good economy. That's how you got to model it up. You got to model it up now and make sure you're not going to lose your ass, and you need to model up a stabilized version and what you think it will be in a good economy.
So another example, I told you I'd give you a few. Brian's entry into commercial real estate was exactly this scenario. Okay. We had been investing in apartments in like 2005, 6, 7. Okay. That was the run up. Everything was hot. And then the market crashed. Mm-hmm. And so some of those same apartments that were going for 30, 40, 50 a door, we were picking up in 2010, 11, 12 for 9, 10, 12,000 a door. Okay. And so one of the first deals that we bought a package of 318 units at 9,000 a door, if you can believe that.
8,900 to be exact.
And so then we won it at auction. And once again, it didn't look like a good deal. It looked like a lot of work and a lot of risk. But I pitched you on it, and you invested, and we tripled your money or quadrupled your money. Yeah. And so, guys, that's what we're talking about here, is those opportunities. Hopefully we're savvy enough to take advantage of them. Is there can be some huge returns buying foreclosed assets during a market crash. And we hope that we get to see those.
The beautiful thing I love about that story is you guys aren't the only ones who've made millions of dollars on those same shitty apartment complexes. Since you guys have sold them for a bargain to somebody else, they sold them to a bargain for somebody else, made millions of dollars. They sold them to a bargain for a bargain to somebody else and made millions of dollars.
Yep.
Right. So that's how this works. If you think about if you guys held on to it now, like, hey, we bought these for 8,900 and they're worth $50,000 a door or something crazy.
Yeah. Well, so there's always that question. I mean, if you hold on to them too long, they'll be worth 30 again instead of 50.
They'll go back down.
Yeah.
Exactly.
So you always want to try to time it, but hey, we made a lot of money and we left enough money for somebody else to make money. Yep. But that's really what we wanted to talk about today. We wanted to talk about the crazy run up, the high prices, the low interest rates that's caused people to lose their minds. Hey, and people made tens of millions of dollars during this time. We passed on apartments, literally passed on apartments that could have made us millions of dollars, thinking that, I don't want to pay too much because we might have this market crash and we might have the interest rates rise, and yet it didn't happen for another 2 or 3 years because of COVID. Well, now we're finally to that point. And so what we're doing is we're shoring up our assets. We're making sure that all of our debt is fixed as long as we can get it. I think most of our debt goes out to 2025, 2026, which I expect interest rates to be a little lower by then. And then we're really looking for people that paid too much, didn't fix their interest rates, got bridge debt, and we're looking for those foreclosures. We're looking for the fire sales. And I think, maybe not this year, but I would say 2024, we're going to be able to pitch you guys a lot of those good ideas or those good properties. And hopefully, we can make triple the money like we did on Brian's first deal. I'm ready.
I want to triple my money again.
I'll
put in more this time.
That's all he wants is to triple his money. It's he doesn't ask for a lot, this guy.
No.
Yeah. Okay. Well, that's a great show. I think the big overwhelming theme, right? If you own real estate, you probably have a loan. Pay attention to your debt markets, right? You've got to keep a fine tune on that now more than ever. But that is it for today's show. We will catch you next time on how to invest in commercial real estate. Thanks, guys.
Thanks, guys.